All right, well, welcome this morning, everybody. 12 o'clock, I guess it's not morning anymore. For those of you who don't know me, my name is djtenhoeve. I am part owner and licensed real estate agent of the Tenhoeve Realty Group at Keller Williams here in central New Jersey. We have an expansion team up in the northern part of New Jersey as well. We are going to talk this morning with a special guest named Stephen Carpitella. He's a close personal friend of mine. He's a branch manager and mortgage originator at EquityPrimeNJ. Their office is based in Manahawkin. Like I mentioned in the teaser video, he's probably one of the smartest financial guys I know outside of mortgages. And he and I have been having a lot of conversations over the last couple of days as it relates to what's going on in the mortgage business, as it relates to real estate, and then just some personal advice as well. There's a lot of conversations and questions out there right now with people asking, what should I do about getting a deferment or a forbearance on my loan? Real estate agents wondering what's happening with the FHA market, because there was some big news about that in the last 24 hours. Buyers asking whether or not they're going to be able to get to closing even though they're under contract. Sellers wondering if their buyers are going to get to closing because potentially losing their jobs. There's a lot of very important questions as it relates to mortgage and coronavirus. So without further ado, I just want to thank Steve Carpitella for joining us today and say good morning, Steve. How's it going?
It's going good. How about yourself?
Rainy day, not so easy being quarantined when the weather's not so nice, but everybody's getting through it. We're no different.
Yeah, that's all we can do.
Yeah. So Steve, I know you and I have been talking in the last 24 hours a lot about what's going on with the stimulus bill, what's going on with the announcement that came out regarding the secondary FHA market, or I should say the lower FICO score FHA market. Let's just start real quick with what is going on with your business right now. I know you have, how many employees do you have with your branch?
We're just about 60 employees.
Okay. What are you going through right now? Do you have business to keep the doors open? Are you worried about keeping your staff employed?
No, we're pretty well positioned, cash wise to, take a hit if we need to. And, basically, our business to some degree typically thrives during these situations because, worse economic conditions typically mean lower interest rates. But in the short term, there's definitely some, pain that the mortgage industry is going through as a result of everything that's about to transpire over the coming weeks and months as it pertains to, the performance aspect of the mortgage industry. And when I say performance, I'm referring to people's ability to continue to make their mortgage payments. So that's what's throwing a huge, rift through the financial markets at the moment.
Right. So what you and I were talking about yesterday was, the stimulus bill got announced over the last 48 hours or so. People are starting to hear questions or rumors whether they should be asking for forbearance on their mortgages or deferments on their mortgages. And we're just about to hit another mortgage payment for these people being due at the beginning of the month, right? So there's what's going to happen in the next week, and then there's what's going to happen if this is prolonged out to the end of next month when the next mortgage payment is due, correct?
Exactly. So, try to keep this as short as possible, but basically, if you think about the logistics of just the cash exchanging hands, right? Our economy, we buy goods and services from each other. We're exchanging cash. And in this case, when a mortgage servicer owns a loan, their obligation is to honor those payments to the investors of mortgage-backed securities. So they have to make those payments to Fannie, Freddie, Ginnie Mae, who does all the government loan programs like FHA, which we'll talk about, obviously, with the FICO changes. And, they have to continue to make that obligation. So, if someone's not making their mortgage payment, the servicer is out that money right out of the gate. They got to collect it from the homeowner eventually. And that's the unknown variable, like what's going to take place, how many people are potentially not going to be making those payments. And that's kind of the whole premise behind the stimulus bill, which is to front load people with cash, so everybody's getting a check regardless without even having to file unemployment. And then they're going to be getting that extra $600 a week with their unemployment filing. And the whole point of that, to carry people over the next 4 months, is to make sure that they're able to make their housing obligation. Everybody needs a roof over their head. So that's kind of the premise behind it. But the fear is that people are not going to be making those payments. And that's what's causing some major issues right now.
Right. So in layman's terms, for the rest of us, if we kind of explain this in a real world scenario. I have a mortgage, and this is fictitious, right? So I have a mortgage.
Yep.
You originated my mortgage. GMAC is the one who services my loan. They're the one I make my monthly payments to. I ask for a forbearance. They're going to give me 3 months of not having to pay my mortgage, but GMAC still has to pay to the backer of that loan my PITI, right? Principal, interest, taxes, and insurance. So they still have to pay that money, even though I'm not paying them for those 3 months, correct?
Correct. So they still have to outlay the cash up front. And, so take your situation, times it by millions, and think about how many billions of dollars mortgage servicers are going to have to outlay up front and hope that they can get the money from the homeowner later when the dust settles.
Right, so the money that they would normally be originating new loans with, right? New paper. They're going to need to stop that.
Exactly. So servicers typically, with the cash they have, with the cash payments that are coming in, they are also buying new paper, right? They're buying loans from originating lenders like ourselves. So if they run out of cash and have to fund all these payments, have no money coming in the door, a limited amount of money coming in the door, keep in mind they still have to pay their employees and run their business on top of it, then they can't buy new paper. So now they're stuck. And now we're stuck, like think of like a fisherman bringing fish to the market and no one's there buying fish. So we're bringing new supply on, and there's only a limited amount of buying of new loans going on. So it's causing a major issue. We can dive down that rabbit hole in terms of interest rates and how this is impacting things in a minute here. But, it's causing servicing values in the mortgage world to be basically valued at zero. There's no demand. There's too much supply. There's too many people trying to refinance right now, but then on top of that, there's too many people who may be losing their jobs and not paying their mortgages. So it's like a complete mess.
So just to back up 1 second, just to clarify something, you gave that reference of a fisherman, right? So nobody buying fish, but the fisherman's still trying to supply the market or can't. We still have refinances going on right now. We still have even new loans coming in right now. But the problem we're going to have is that the servicers who have to pay for those loans that are being forbeared aren't going to be able to take that new stuff on. So it's going to create a logjam, right?
Exactly. That's what's happening right now. Like that's already happened. So that logjam has occurred. So people who were able to get in line early on in this process before the shutdown and have locked in and secured, very low rates, they're getting their money. The rest of the people who haven't locked in are trying to attempt to refinance right now. Interest rates have gone up as a result of it because they're trying to basically curb or slow refinance demand. Like I've heard some stories of like banks actually hanging signs outside saying the rates are 5-6% just to stop people from applying. So it's a unique anomaly. Like if you think about the timing of everything, we just had right before the government shut everything down, we had record low interest rates hanging out with an economy that was at full employment with home prices near all-time highs and an easy credit market. Like none of those people should be hanging out at the same party. That's not the typical scenario. Record low interest rates should be associated with depressed housing, tight credit market, and high unemployment. So it's like someone called the cops and broke the party up, and now here you go. But in the short term here, we don't have record low interest rates occurring, even though they should be. Not to get too technical, but if you look at mortgage-backed securities, which is where mortgage rates are determined, mortgage bond prices are at the highest levels ever, which would suggest that we should be at the lowest interest rates we've ever seen. But that's not translating through to the rate sheet because there's major supply issues. There's too much paper already in the system that can't be bought.
Right. So this is going to be somewhat painful in the next 30 days, but where we're really going to see this is probably 90 days out and then beyond, correct? Unless the government steps in to try to solve this problem for the servicers, correct?
Yeah, so the voice has already been heard. There's already a task force being formulated with the federal government and the Federal Reserve, and they're all getting together and trying to figure out how to extend a lending hand to the servicers to, basically it's a liquidity issue. There's just, everyone's going to be strapped for cash right now because people are potentially not making their mortgage payments. There's a record amount of, I got some stats just over the last few days, but a record amount of phone calls for mortgage deferrals and forbearance with, overwhelming customer service in the mortgage industry. And, that's just if that's a sign of what's to come, that's where all this pain is coming from. Like there's big indications that, there's a lot of people looking to not make their mortgage payments.
That's a really good question, right? Sorry, I'll let you finish.
Yeah, go ahead.
So that's a really good question. And I think some people who are on the call today are probably on just wondering whether we're going to answer that question, which is, okay, I still have my job, or I might lose my job in the next couple of weeks. Regardless, should I be calling my bank that services my loan and asking them for A, a forbearance, or B, a deferment, and what's the difference?
Yeah, let's talk about that, because that's the education process that needs to go down immediately to the masses. A forbearance is basically like a timeout. So let's just say you called GMAC, your mortgage, right? And you say, hey, GMAC, I need I need 90 days. They're going to say, okay, no problem, DJ. Don't make a mortgage payment to us for May, June, and July. But on August 1st, you're going to owe us all 4 payments. So, the problem is, people don't realize that they're going to owe all those payments. It's not a deferment. So let's talk about a deferment. A deferment is taking that May, June, July mortgage payment and moving it to the end of the loan.
Right, tacking it.
Therefore, you would just get back on track. You get a 3-month cash flow reprieve. A forbearance is not a cash flow reprieve. It's just hey, we're going to give you a little bit of time to get situated, get your cash in order, and be able to get back on track, with this temporary hiccup. And that's the difference. Like, that's what people got to realize. The mortgage company's not doing you any favors forbearing your mortgage. You're going to owe the full boat. Some of them will allow that forbearance to be extended over a short period of time, maybe over 6 months or something. But just keep in mind, your mortgage payment's going to, in some cases double. Depending on the amount of time they're allowing you to pay it back. You need to be prepared for that, and that's the whole point of the stimulus package. Again, the Fed's sending out a check to every homeowner automatically. Like, automatic checks are going out. I don't know if everyone realizes that. It's part of the stimulus bill. Everyone's getting a check, depending on how many people you filed.
$68,000 a year on an annualized basis, correct?
Well, that's separate from this. So the first part is there's a check going to everybody for as much as $2,400 and $500 per kid, depending on your last filing status. Those checks are going to be automatically deposited in everybody's account. And if there's no online account, or if there's no routing number or anything like that on your tax filing, it'll be mailed to the last address of wherever you filed your tax returns. So everybody's getting a check. Just about everybody. Unless you made over a certain amount of money, then the check will get whittled down as your income increases. So everybody's getting a free check right out of the gate, regardless of whether you're unemployed or not. And then, to help everybody with just the hiccup, right, the economic hiccup, whether you lost your job or not, you still, everybody's, got some sort of issues going on in terms of cash flow. So they're trying to get ahead of this and get everybody some cash to sit on. And then there's the extra $600 a month on top of unemployment. So like in Jersey, it's like $715 a week. So for a 4-month period, they're going to get an extra $600 a week on top of that. So if you annualize that, it's about $68,000 salary for a 4-month period. With that and the stimulus check that goes out, the hope is that they're trying to firm up everyone's balance sheet, if you will, or cash position to be able to make their housing payments and not sink the housing industry as a result of this. Which again, you've been around. You saw it happen in 2008. That was more telegraphed, right? We saw that coming. We started losing jobs, 100,000, 300,000 jobs a month for periods of time. Think about that. That's 1 million jobs in 90 days. This was at least 10 million jobs with the flip of a switch.
Just overnight, right?
So yeah, this never happened before. This is unprecedented. There's no playbook for this. This is no one really thought this one out, but now we're reacting to it and trying to mitigate the damage. So for lack of better words, and not to get all doom and gloom, my words are we basically just took an elevator to recession as a result of shutting down global economies.
Right, and what not just necessarily the Fed, what the government is trying to do with the stimulus bill is try to keep this going as long as we can so that as hopefully if this is in the short term that we get back to operating somewhat as normal, that period of time, this is the Band-Aid, right? This is the Band-Aid to get us back.
Exactly. And, just to put this in context of us with, other countries I won't name, but, talk about some things that maybe we take advantage of. Like, we still have the ability to conduct commerce. There are still a lot of industries that, we're able to work from home. We have the infrastructure. We have Wi-Fi. We have, the whole infrastructure set up where that's possible. So a lot of businesses are continuing to function at some level. In some countries, that's not the case at all. They can't work from home. I'll tell you right now, there's a country that does a ton of outsourced customer service calls for mortgage servicers. They're completely on lockdown. And when I say completely on lockdown, like martial law lockdown, like people can't leave their house, and they do not have the infrastructure to work from home. So there are people trying to get a hold of their mortgage servicers right now, and they're not getting any answers, and that's why. So just to kind of give you the magnitude of how big this thing is, it's unseen. We're in uncharted waters.
So dial this back to the question we asked in the beginning, or at the beginning of this portion. If I'm a homeowner right now, should I be asking for forbearance or deferment if I'm still employed?
If you're still employed and you can make your mortgage payments, by all means, do everything possible to make your mortgage payments. You should kind of jump into, your contingency plan. And your contingency plan should look like this. You need a roof. You do not want to risk foreclosure or the equity and money you have put into a home. That is your most treasured asset, right? I don't think anyone's going to argue that.
Sure.
So you want to protect that at all costs. So, budget accordingly, make your mortgage payment at all costs. If you have a cash flow crunch, maybe, I know some people have gotten just a reduction in their compensation, but they still have their jobs. They got to go in that contingency plan. Make your mortgage payment, make the adjustments you need to make there. And then, as far as like credit cards, if you have any other debt, student loans, credit cards, that's unsecured debt, right? Student loan companies can't come back and take your education from you. Credit cards can't come back and take whatever you may have purchased and potentially even consumed, right? So, those things can be forbeared and those things can be deferred. In worst case, you default on those items, but you're not going to lose your house over it. So it's kind of unsecured debt is first to stop getting paid or try to negotiate some sort of forbearance or deferral. Then your car, because typically you need a car to go to work, although nobody's really driving to work right now, right? Unless they're in a specific industry. Then you try to work it out with your car company, but your mortgage should be the thing that gets paid above everything and anything. Like the housing industry is the heart of our economy. It employs just about every trade you can think of. So that's why they're trying to protect this and try to get us through this, 2-3 month hiccup or whatever you want to call it,
Sure.
So if you have a job and you can make your mortgage payment, I had a conversation with a gentleman who said, oh, well, my wife had is going to lose her job. But I know this person, and I was like, look, your income's more than substantial to cover your mortgage payment. You can make the necessary adjustments. Do not forbear. It's just not the right thing to do. And in fact, if anything, he qualified for a refi. So I'm like, look, you can forbear your mortgage payments, which you're still going to owe, there's no financial benefit, as we just discussed, or, potentially refinance and get to a lower interest rate and save $200 a month. Like, kind of a no-brainer, So, some people, I think, and I'm not trying to go there, but some people maybe think they're entitled to something and trying to get something out of this. There's nothing really to get. The thing that's going to probably get most people in trouble is trying to forbear, you taking the money that the government's giving with a stimulus check and the increased unemployment, and then being in financial hardship at the end of it and saying, oh, well, where's the money? You haven't paid your mortgage payment. Your mortgage payment's $2,000 a month. Where's the money? You should have $6,000 saved up, and I don't have any of that. Well, what'd you spend it on? I paid my credit cards. I paid this. I paid that. Yeah.
And then at that point, now you default on your loan, and now you're
in a real default. Yeah, because
potentially going towards foreclosure.
Exactly. Because now the economic event has passed. Let's just say the economy's turned back on at that point, and you're back on your job. Now you have a bigger problem. Now, worse than what just happened. Now you defaulted on your mortgage agreement, and there's really no love there. Like the mortgage service is already out. They're trying to collect. At this point, they want to protect, their vested interest for the investors. So, now you go into what? Loan modification? Now you just trashed your credit. That's the other thing. A forbearance is not going to report positively on your credit. When you make that call and you forbear, you're waving your hand in the air. You're saying, I'm done. I'm cooked. I need help. And, that's considered a credit event. So, the chances of even getting a refi when the dust settles is going to be a problem now.
All right. So
especially if you have to end up going into modification.
That was one of the questions we had from Blake Lawrence. He said, what, if any, will be the effect on the credit scores for a forbearance versus a deferment? Are they counted equally or not?
Yeah, it's going to have a negative impact. I can't state the amount of points that it would potentially hurt someone's credit scores. But as a mortgage lender looking, let's say that person wanted to come back and refinance after the fact, we're going to have to deny the application automatically regardless of the credit score. Let's just say the credit score is still 740 for some reason. You had a financial hardship that is documented, and now we're going to want to see on-time payments, probably 6 to 12-month on-time payments, to make sure that you stabilize before we'll even make a new loan. Because again, we don't want to be in a situation where we're forbearing. When you forbear, you're saying, "Hey, I can't make my mortgage payments. I'm basically screwed."
Gotcha. One of the other questions that came in here from Vinny Abatello. Sorry, I always say your name wrong. Overall thoughts on where the rates will go in the next month or two?
Yeah. So my thoughts are this. I mean, just speaking fundamentally from 18 years plus of working in this industry and having extensive knowledge of global financial markets, in particular the bond markets. Again, this is typically when we see record low interest rates. And again, if you look at mortgage-backed securities today, we should probably be looking at rates in the upper twos right now. If what's called the SRP, service release premium, or the servicing value given to loans, that's literally evaporated from a rate sheet today. So that, if they extend a helping hand to the servicing industry, which will probably come in the form of a line of credit, by the way, and allow them to, the liquidity to get through this as well. If that stabilizes and the amount of people, that do not forbear and can get those servicers paid back, time's going to heal all wounds here. It's really going to determine on the level of damage that is or isn't done. The less damage that's done, the quicker interest rate that servicing guy is going to pop back into the rate sheets, and the lower interest rates could be. And again, how bad does the economic conditions get? There's speculation we go to 25% unemployment temporarily. And do we really kick back as hard as everyone thinks we're going to, right? We want to remain optimistic. Does the economy really bounce back as quickly after all this, or did things change? Are we in a new world now? Have certain industries, changed completely in terms of their landscape? That's all going to be a determinant. So kind of give you a wide range here. The less damage that's done as a result of this whole event, the quicker interest rates will resume back to, at least historic lows, if not record lows. The more damage that's done, it's going to be a little tricky. It might take a little more time for interest rates to come back until the mortgage industry kind of heals some wounds here.
When you say come back, you mean that they could be elevated for a period of time until they drop again.
Exactly. Just to defer, because think about this, why would I lend John Doe money today when he's already got a mortgage with ABC Mortgage Company, right? That's the ABC Mortgage Company's problem right now. Why would I refinance and close him today, and then he loses his job next month, and now it's my problem?
Right. So
there's a little bit of that going on, right? So the whole industry, the mortgage industry, we're going to go back to, the easy credit market. It's over. It's done. I'll tell you right now, there's a complete recalibration going on as we speak right now in terms of reevaluating underwriting. And they're going to look at industries. What industry is somebody in? Somebody who's a self-employed restaurant owner applying for a refinance today. Sure, their 2018-19 tax returns are great. They're currently not working. So how do you, even though they got great credit, cash in the bank, there's going to be scrutiny starting to be looked at in terms of, wait, this is a restaurant owner. His restaurant's not even open right now. You know, so how do we lend that person money when we have no idea when they're going to be back up and running, and are they going to be at full capacity and just as profitable as they were prior to this event?
Well, does it also become a long-term question for the underwriting departments as to what industries were less impacted by this? And do those people who are in restaurant business, for example, do they become less attractive to the lender versus somebody who's a contractor who is essential business?
100%. Absolutely. That scrutiny is going to start to come into play in the coming weeks. You know, like every day we're one day closer to really seeing the impact of this. Every day we're one day closer to potentially going back to work and starting to resume the economy. You know, so it's just too many unknown variables at this point to pinpoint when rates will come back. But again, the less damage done, the sooner rates come back. Or, you know, if the Fed and this task force work it out for the servicers and make them whole, it could come back right away. So, I mean, we could see, you know, next week they make an announcement, say, hey, we're going to back the servicers, which potentially may happen, by the way, and we're going to resolve these issues, and we're going to exonerate, you know, the originating lenders on any what's called EPDs, early payment default. Yeah, so, you know, just give you a quick example on that. I had a borrower reach out to me who just closed on a refi and said, hey, I just lost my job. I'm not going to be able to make my first mortgage payment. That's a huge no-no. Like that, you can't make your first mortgage payment if we just closed the loan. It's not even saleable to Fannie, Freddie, or Ginnie. So the servicers can't even buy it. So then the originating lenders are stuck with it. And that's a huge, another huge issue that's going on right now too. So hopefully whatever they work out, they're going to be lenient on the originating lenders, because it's not like we made, you know, Jane Doe a bad loan. She's got great credit. Her debt ratios were great. She lost her job. How did we know that was going to happen 30 days ago?
Right.
You know, so like it's just a different, like I said, unprecedented event. So everybody's trying to figure that out and sort that out right now.
That's great information. Nancy Coviello has a question here sort of tied into this and then moving into the FHA conversation, which is, can you ask if banks will be loosening borrowing requirements going forward, giving consideration to people who may have lost income for a period of time? I think you just answered that for the short term, that banks are actually tightening and paying more scrutiny to the people who were in industries affected and are non-essential business. But can you talk a little bit about what happened with the FHA market and the sub 640, I think it is, FICO scores?
Yeah, so you hit the key word there, tightening, right? So easy credit's over. The tightening credit market is here and emerging upon us. I'm going to jump around real quick, but we'll start with FHA. So, you know, again, it's a little different on the servicing end for Ginnie Mae loans, for anything that's VA, FHA, or USDA. Ginnie Mae is the backer of all those mortgages. It's a little worse for the servicers on those loans. Because, you know, they're obligated, you know, on the conventional loans, they're paying the principal and interest. The tax and insurance, the servicer is just paying on their own. But the government insured loans, the servicer is required to pay the full pity. So it's even more of a cash flow crunch. So that market just got destroyed last week. And that's why you see this move to everyone going to a 640. So not everyone, by the way. I'll get to that in a second too. So most people are taking a conservative approach. They're going to tighten their lending standards. They do not want to take the risk of paper under a 640 credit score, because there's usually some layers of risk associated with it. But the people who have their Ginnie Mae licenses, so like just to give you an example on how EPM is handling this, we are
EPM being
keeping
Equity Prime Mortgage, by the way.
Equity Prime Mortgage, yes, correct. EPM is handling this. We have our Ginnie license. So since there's no buyers of paper out there right now, we're going to continue to stay at the 500 credit score that we're at, which is what we're allowed to do with the Ginnie license. So we're not making the move to 640. We're going to continue to make credit available because it's more needed now than ever, right? There's still people that, you know, may have those situations, and as long as we underwrite the risk properly, it's all about underwriting the risk, right? You know, just because you had an economic event or something happened doesn't mean you can't pay your mortgage on time. So as long as we do our diligence there and underwrite the loans properly, we'll still be able to fund those transactions. Probably some other lenders,
though, right?
What's that? The rates will be higher, yeah.
On those clients. I mean, they normally would have been even in a normal environment, but they're going to be higher now because of the risk you're taking on for those clients.
Yep. And, and put this in some perspective to interest rates too. we're still accustomed to low rates, right? Ever since the financial crisis, it's almost like, even when rates got out of the threes and went to 4%, I hear people tell me, oh, 4%, such a high rate. And I just kind of laugh. Like, it's not a high rate. Our parents and grandparents are paying in the teens. Like, we're probably never going to go to double digits ever again. So, like, for rates to maybe go to, 4.5%, 5% for those borrowers, and the fact that they're able to still buy a home, I think these are still historically low interest rates. So it's all got to be put in relativity. And then again, they're probably going to end up refinancing after 6 months when they're eligible for an FHA streamline anyway, and getting a lower rate as long as they've done the work to the credit and got the credit scores up. So, a 30-year mortgage just isn't a 30-year mortgage for anybody anymore. Like, people refinance constantly when there's opportunities. So, we're still allowing people to get into into homeownership, and that's the key. That's what can't stop, right? If that stops, we got bigger problems. So we're taking the stance to continue to lend money and be there for people, and probably other Ginnie licensed lenders will do the same.
So this is just lack of information on my part. What percentage of FHA originators have a Ginnie license? Any idea?
I don't even have that number, no, but it's not as many as you think. I mean, because you figure loans are originated through brokers, mortgage brokers who are not lenders, who go to, that's a good chunk of mortgages that are written in the country there. Not all mortgage bankers, like, we're a licensed mortgage banker, so, like, brokers use us to lend money, for example. So there'll be a lot of mortgage brokers coming to us for that 500 plus credit score borrowers, because we're one of the few outlets that are going to be doing it. But a lot of mortgage bankers do not have their Ginnie license. It is very hard to get. You need a certain net worth to even obtain it, and demonstrate loan performance in the past and pass several audits. It's not an easy thing to obtain. So I don't know the percentage, but you can lose your Ginnie license as well. There are lenders that have lost their Ginnie license and may lose their Ginnie license as a result of this whole mess.
Sure. So for realtors that happen to be paying attention to this, no matter where you are in the country, if you have somebody who's under contract right now who might fit that profile of a sub 640 FICO score, and you have them in an FHA loan, you may be hearing some bad news from your lender if they don't have their Ginnie license, and you may be having to find another lender, which the great news is that there's other lenders out there like EPM that can do it, right?
Exactly. So the lenders that are raising their scores to 640, you can pretty much assure that they don't have their Ginnie license. And whatever investors they're ultimately, transferring or selling servicing rights to post-closing, don't either. So, yeah, we do have our license. We're willing to do those loans, and it's just a matter of, making sure the overall credit profile makes sense. They're underwriting the risk properly. So it doesn't mean they can't borrow money. Like the industry has not shifted to 640. I just want to make that clear. So if you talk to lenders, like, oh, you can't do this, it's they got a 630 credit score. That's incorrect information. There are lenders who are going to still be able to do it.
Gotcha. And for a client who is with a lender that is moving to that new standard of 640 or above, and the person who's already gotten their application and happens to be a 610 credit score, if they are locked, can they move forward with that, or is it done?
It depends on the lender and whether they're willing to honor those or not. I would imagine, given the state of everything that's going on, they're probably going to kill those deals and just walk from them.
Got it.
You'd have to ask the lender right away whether they're actually going to honor the deal or not. If they've pulled the 640, chances are they just want to get out. They don't have an outlet to get rid of the paper, so they're walking immediately. And if they've got to kill some deals, they're going to kill some deals. So in a lot of regards, just to touch base on this before I lose track, this is not 2008, but it is to some degree worse than 2008 from the financial market aspect, because again, like we started this conversation, the mortgage industry is kind of broken right now. Mortgage servicers are going to take the brunt of this, and they're going. There's major servicers. I mean, you think about some of the top companies. Again, won't name names, but some companies that service probably about there's probably a handful of companies that service about 60% of the paper in the country. Some of them are on the brink of failure. Like literally, they're on the verge of being done. Like, that's how bad the situation is. So You know, and then talk about that. You guys have talked to me in the past about like non-qualified mortgages. You know, the new subprime mortgages that were coming out, the bank statement programs, and the stated programs, and the no income verification programs that have all started to come out over the last several years.
Right.
That entire industry, as of right now, is done, gone.
Do jumbo loans and super jumbos fall into that?
Done. Yep.
So why is that?
There's not enough because of the liquidity issue, you know, and kind of the bigger they are, the harder they fall. You know, this is an unprecedented economic event. No one's sure how to underwrite this, meaning like really assess the default rate. So after 2008, I don't call it PTSD in the mortgage industry after 2008, but like we've learned our lesson once, we're not going to learn it twice, right? So everyone's like, hey, risky paper, big paper, walk. It's just not even worth doing. The only people that are probably still doing jumbo loans at this point are maybe some of the big banks and wealth management. Other than that, that whole market is dried up and done for the moment. I say for the moment because that's probably temporary for jumbo loans. But for non-QM, it might be done completely. There are companies, again, I'm not going to name the names, but there are companies that are either done or have laid off and fired 90% plus of their staff and are basically, the only reason they're still active companies is because they have paper to be serviced. These are portfolio loans. These aren't Ginnie Mae, Fannie Mae, Freddie Mac loans. These are loans that are portfolio. They're sitting on the books of the company that lent the money. You know, those investors in those companies, you know, they don't want any part of this. So everyone's pulling out. Everyone's just like, I'm out. Like, you know, we'll maybe revisit this when the dust settles and see if we even want to bring this back. But everybody's very scared to jump into that market. So there are people under contract that we had that were supposed to close last week. We can't close the loans. Like purchases, refis, done. They just will not fund the transactions. So like very 2008, 2009 in that regard.
So let's play the scenario out for a couple people who might be, you know, prototypes of folks on the phone right now. I'm a 760 credit score. I'm buying a house for $1 million. I'm putting down 20%. So the loan's going to be $800,000. I have a job. I'm employed in my company's essential business. Should I be worried that my loan isn't going to actually, and look, I understand that you have to look at the specifics of every person, and guys, if you're following this, just know that Steve can't give rates over the internet. He's got to look at everybody's individual scenario. And we're also not giving financial advice here. I'm not a certified financial planner, nor is Steve, to the best of my knowledge. But if I'm that person, right, buying $1 million house, $200,000 down, $800,000 loan, going conventional financing, should I be concerned that I don't get to closing in a month?
Well, again, if it's over, you know, let's define jumbo versus high balance. You know, like if it's $765,000, you know, it's a Fannie Mae loan in Monmouth County, for example. You know, I would recommend to that borrower to put the extra money down and get to $765,000. They're going to have an easier shot at getting a mortgage. But those mortgages, like Fannie Mae, is still lending money. There's nothing changed there. You got a good economically viable borrower. There's not going to be any issues in closing that loan. The jumbo aspect, as far as it goes from, you know, a mortgage broker or a mortgage banker, to my knowledge, no one's doing jumbo loans right now. They'd have to go to a bank and apply for jumbo paper.
Got it. Let's play the alternate scenario, right? I'm a first-time home buyer. I'm putting down 3.5%. I'm still employed. I haven't been furloughed or laid off yet. I'm closing again in another month. I've already done my application. We're moving through the process. I've got a 680 credit score. Is that also somebody that should be concerned because they're a little bit different? They're in a more viable market, meaning a lower price point. Say I'm buying a $550,000 house, putting down 3.5%.
Yeah, no. So let's just kind of see where this is going. So let's just go right to this point. We're still a functioning business. All lenders are. Like, we're still lending money if it meets the profile. So, like, we're not stopping lending money. So that borrower with a 680 credit score, FHA 3.5% down, no problem. You know, as long as, you know, we're going to scrutinize employment and look at and make sure that their likelihood of employment is going to continue. But again, this is the next 30 to 90 days are super tricky because, and again, just to kind of talk about, what's about to take place. Again, like we mentioned, like the first billing cycle went through, we're about to hit the second billing cycle. Businesses are holding on, barely holding on. I know tons of borrowers I have right now who are, I don't know what's going to happen with my job. Like there's a lot of uncertainty. So, that may appear initially as a qualified loan, and then literally, it could be the week of closing and they get furloughed. They're not closing. So like that's probably going to be a very common scenario in the next 30, 60, 90 days as, the initial round of layoffs and unemployed people has gone through. That each billing cycle, every business is under that much more economic stress, and they're going to start making those planned cuts. And that's where everyone's predicting, certain people are predicting that unemployment could surge to at least 25%, which is unheard of, never happened, right? So that's that's how big this thing is. So like it's going to be really tricky over the next 60, 90 days while the economy shut down, or however long it's shut down for. That's going to be the hardest part of underwriting, is just the next few months. After that, when the kind of like, all right, the dust is settled, we're back to work, it's time to start turning the economy back on, things are going to shift right back immediately. Again, so this is a very unique event, and the fact that, this is more of a proclaimed temporary recession overnight, right, as opposed to a period of time. We had a perfectly great economy prior to this happening, right? So, just talk about, being at the top and going right back to a level playing field. That's just going to be the challenge of the next couple months, and seeing who ends up still remaining employed versus not. A lot of people are furloughed right now that we're talking to, who are thinking they're going to be back to work in 6 weeks, but we don't know that, right? No one knows if they're going to be back to work in 6 weeks or not. So it's going to be real tricky. Like, just kind of set the expectation for you. So like a good borrower, economically viable, no job loss on the like they have an essential business. It's, some businesses flourish during times like this, as you know, right? So, like if everything looks good, they're going to get their money. No problems, no questions asked. But everyone else, there's going to be some scrutiny when looking at certain industries.
Right. So that actually.
Someone in healthcare.
Go ahead, Steve.
Yeah. Someone in healthcare, I don't think we have to worry about anyone in healthcare having a job right now.
So this kind of ties into a question that's both affects you and affects me both as a real estate agent. Dana Chabara has a question. She says, so should I be worried about selling my house right now? Is this something I should be concerned with? And that's a very valid question from a lot of people. And I can tell you, I face this question multiple times a day right now. And the answer from my side of things is it depends. It depends on what your motivation is, what your needs are, and also what the property you're selling is, whether it's a second home, whether it's a primary residence for the person who's going to be buying it, and who the prototypical buyer is for that house, because that helps us decide whether or not that client or that buyer is somebody who seems to be at risk right now. And you might be putting your house into a pool of people that has dried up versus a pool of people that is still buying. From your perspective, Steve, I know you can't give necessarily advice to everybody with one statement, but what is your outlook on home sales, new home purchases over the next 60 to 90 days?
Yeah, it's an interesting one, right? It's like, again, there's like no real known answer. It's like you hit the nail on the head. Like there's going to be a million different variables right now. That's kind of where, someone threw a deck of cards in there, like that's kind of what's going on. We're going to have to piece through where do you work? What industry are you in? How is it being impacted? Are you even a viable buyer? You may have a job today. It doesn't mean you're going to have a job tomorrow, kind of thing. And then people where there's just no question that they're going to have a job or not. So I think that, again, the level of scrutiny is going to be high during this period of time in terms of making that determination. But I've kind of seen a mixed bag. It's really, and I'm going to just kind of speak freely here, so hopefully not to offend anybody, and just kind of walking or talking through this. But like, I see some people who are, it's just like nothing's even going on. It's business as usual. I need a house. Give me a house. I got a job. I got the money. I'm buying a house. And they're full blown moving forward with no concerns at all. So I guess like it kind of comes down to necessity, right? Necessity is the mother of invention. Someone's at the point in their life where they've saved their money and they feel comfortable with their job and they're out there looking to buy a home. And then I think there's some people that are out there kind of doing it and haven't really thought about the ramifications. We've seen some people kind of pull back. So we've kind of seen a mixed bag of all of it, where we've had people go under contract and they're like, oh my God, I'm backing out. But several clients pull out of contracts immediately. A couple people, again, who have had pay cuts, they still have their job, have pay cuts and pulled out because they're like, oh, this changes my whole situation. I lost 25% of my pay. And then we've seen sellers try to pull out as well. So I think, like you said in the beginning, you hit the nail on the head. Every situation is going to literally have its own DNA right now, right? We don't know how every single person has been impacted by this. Some people let's talk about the wealth effect, right? The wealth effect is what carried this economy as far as it's gone, right? Everyone's 401k, invested assets. Everyone felt like they have money, right? People have borrowed against that for down payments and done other things, home improvements, et cetera, et cetera. Like, it feels good when you look at your 401k statement and then, the market just, had its correction as a result of this, and which may actually get worse before it gets better for the record. People have lost 30, 40% of their net worth. There's some people that were on the verge of retirement who are now like, I can't retire now. So, there's so many different angles to look at this. Like, everybody's situation is so unique right now and how this situation has impacted them. So again, some businesses are flourishing as a result of this, right? Which is crazy to think that, there are businesses that do well during this and there are businesses that are, devastated as a result of this. So it's impacted everyone in different ways. So I think, it's just really, this is the meeting I had with my team last week. Like, we need to switch gears. We need to recalibrate. And we really need to look at each individual situation and what's really going on and advise accordingly. I have given some advice to certain clients where I'm like, I think you should hold off. That's my 2 cents. And other people where I'm like, nah, man, I think you should keep moving forward. You're in good shape. Your job's stable. And there's opportunities out there,
Yeah, and for anybody who hasn't seen the stuff that my team and I have been putting out on a daily basis, we're tracking statistics for both Monmouth County and Bergen County on properties that are listed in the last 24 hours, properties under contract in the last 24 hours, properties closed in the last 24 hours, and properties withdrawn from the market in the last 24 hours. We're looking at that, look at yesterday's data and then compare it to a year ago, the same day. Our hope is that from a county perspective, and we can drill these down to your specific town as we're trying to discuss whether it's the right time or not for you to sell your house, whether or not certain markets have dried up and how vast has the disparity become in what's going on right now. Has the market completely imploded? Is it gone compared to where it was a year ago? So it really is a case-by-case scenario, a town-by-town scenario as well. So I would just urge you to make sure as you're making those decisions, work with your professional realtor to figure out whether it is the right time or whether it's 2 months from now or 3 months from now or until we get a light at the end of the tunnel. Another part that is in part of one of the questions here from Dave Keller, he wanted to know for second home markets, vacation properties, do we think that we're going to start to see more defaults on that in the future? Any opportunities coming up? And I would also tie in with that as a conversation you and I had yesterday, Steve, which is the commercial market. What do we see coming on that front?
Yeah. So as far as, talking about like the default and potential opportunities, again, several outcomes could come from this whole situation. If I'm more of a plan for the worst, hope for the best kind of person, very positive outlook on life in general, but I am a realist and I look at the real aspect of things. If the longer that we have the economy shut down for, the issues are exacerbated exponentially, because every billing cycle that goes through is affecting every industry. So for example, every tenant is asking their landlords for forbearance, right? Or a deferment. The cash is not changing hands, not only in the mortgage servicing industry, for example, but in every industry. I got people in freight who are like, yeah, nobody's paying for their freight, but we're expected to still go out and deliver. Like, that cash isn't coming in the door. Like, businesses that aren't, they say cash is king. Like, businesses that are not flush with cash right now or can't get the necessary loans to stay afloat are going to have major issues and major problems. And that's where the potential for massive layoffs happens. And yeah, what are you going to pay first? And you have two houses, right? You have a second home. What are you going to pay first? You're going to pay your primary home. You're not going to pay your secondary home. So, I think it's a foregone conclusion that, yes, you're going to see a spike in foreclosures and second homes, right? That's discretionary spending. It's not necessary spending. So you're going to see an uptick in that market, or people potentially trying to sell and get out as quickly as possible. You may have some really motivated sellers, DJ. That's what I would think would happen as the next every month that goes by that we're shut down, this is just going to get worse. And the screws are kind of being turned on those people, so to speak. So, I know people in lots of industries who are like, I don't even know where my next paycheck's coming. I have no idea. Like a lot of, small businesses or self-employed people, a lot of advisors and consultants. I mean, just the spigot is shut off right now. No cash is changing hands. So, I got to expect that default's going to rise. I would expect that second homes would be the first to take the hit.
Yeah, and then it becomes
and potential investments. Yeah, and potential investment properties. Tenants aren't making their rent payments. Some of these, some of these loans that are done on debt servicing. So, like, the rent covers the mortgage. There's a lot of exposed real estate investors who do not have the cash flow to cover those mortgages. So again, like, I think that risk on any type of secondary or investment property, those foreclosure rates are on the rise, depending on how quickly we get back to work. Every month that goes by, it's just going to exponentially go higher.
Yeah. So for anybody who's got a multifamily property, investment properties, and the people renting that property work in the restaurant business, for example, or any businesses that have been affected where they've been furloughed and they're not paying, their rent, that's going to hit those people as well. They're going to end up having to eat those costs. And we all know how long it takes to evict somebody, nor do they want to be the landlord who does that in this scenario when someone's been affected and really had no control over it. And it might ameliorate itself in the next 90 days.
Yeah, and again, like the education that's needed, I mean, they should run commercials on this. I'm not even joking. The money that the government's giving out is to stop that intended consequence from happening. It's not free money. It's to make sure you can pay your rent. Just like it's to pay your mortgage, you know what I mean? So, like, they're giving money to everybody. They're raising unemployment for that reason for at least the next 4 months. If this continues on beyond that, they'll obviously make tweaks and add another stimulus bill. So they're going to want to try and underwrite and keep the economy afloat as best as possible and do, just minimize or mitigate the collateral damage. So, yeah, it's just, again, next month, it'd be interesting to see how next month, the month of April goes, whether we get back to work or not. And if we don't, I can tell you right now, another round of layoffs. And that's just going to add more pressure onto the housing market. But again, government's giving out money. If anyone's listening, take that money, be responsible with it. Pay your housing expense, rent or mortgage.
Right. So for every,
you can literally save the economy.
All right. So every month that goes by, these businesses have to lay off more people. When the layoff numbers come through to the stock market drops accordingly. And then your 401k is dropping at the same time. So it's a snake that's eating its tail over and over again. And then eventually the government has to come in with a program like HARP, that we had after the last financial crisis, in order to be able to let borrowers or homeowners right now drop their mortgage rates so that they can actually have purchasing power to go do other things. Otherwise, we end up in a prolonged recession or depression, right?
Exactly. And that's why, like, whether, I don't know what anybody's opinion on the stimulus bill is or not, but I could say this from the last economic crisis, they reacted way faster, which was way better than what they did last time. We learned our lesson on the last downturn. The fact that they were able to pull together and get something signed and start getting checks out the door, which are supposedly going to be hitting people's bank accounts within the next couple of weeks, is a pretty amazing feat in itself. But again, the opportunity there, hopefully a lot of Americans don't squander that opportunity, and it's really there to help save the economy and save the housing industry. Like, that's the underlining tone here. That message has to get put out there,
Yeah. So just real quick, we'll take any questions you guys have that you haven't asked so far. So please chime in the chat box and ask those. But in the meantime, I just wanted to touch on something sort of unrelated or a tangent to the conversation we're having right now that you and I had yesterday, which is you've got these employees who have now been sent home and working remotely. So you, for example, me, for example, we have a lot of flexibility in our job, meaning that we're not in an office always all day long. We're out and about. We've had that flexibility for as long as we've been in these careers, but there's a lot of office-based employees that now are working from home. And I'm sure there's some growing pains to that, right? Like, do I get out of my sweatpants in the morning? Am I having a beer at 2 o'clock in the afternoon? But they're going to start to enjoy some of that luxury that they don't have when they're commuting to an office Monday to Friday, every day, and fighting traffic. And what societally happens now where we open back up for business and employees say, Yeah, I don't want to come back to the office. I still want my job, but I don't want to work out of an office anymore. What downline trickles down from that?
Yeah, I mean, again, I think the writing's on the wall there that, you know, I think this is where we talked about commercial real estate. I think commercial real estate takes a hit, a potential hit here, in the sense that, you know, yeah, some businesses just, you know, are going to realize they can be viable without a location. I mean, we're running. I have an office. There's nobody. Well, I got one person who shows up to get UPS packages and things like that. But like, there's nobody there. We're still a functioning mortgage company. You know, virtual from home. You know, so the day and age of technology is upon us. This may have just pushed the fast forward button on that, and it's going to open a lot of people's eyes to, hey boss, I can work fine from home. I've been doing actually great. Actually, I feel like I get more done. I'm not spending 2 hours driving every day in the car. I'm saving money on my commuting expenses. You know, like all of those things. There's definitely benefits to it if you are a self-starter and are motivated, right? If you have that discipline. So I think that's going to be an eye-opener for a lot of people. Certain businesses may realize they don't need as much space as they needed. I mean, I can tell you right now, my office seats 25 people. We have 60 employees.
Right.
I don't need to go find a space for you know, like to me, like my office is more like a university. You come here, you learn your trade. If you graduate, you go work from home. So, you know, while keeping certain people there, managers and supervisors and things like that, to handle and facilitate training. So, you know, my mind, I'll never need more space, you know? So, yeah, I think that's going to be an eye opener for a lot of people.
I think along that line, there's just a massive change that is going to happen with all of our lives as a result of this. Doesn't matter whether it's only another 45 or 60 days. This has been sort of the straw that broke the camel's back that's going to cause some massive sociological changes to the way we interact. You and I were talking about it. How quickly do people want to go back to bars and restaurants? They're going to be seated on top of one another. You got restaurant owners now that are being told they have to move their tables 12 feet apart or longer distances than where they had. So they're losing occupancy in their restaurants, cutting them down in half. How does that become a viable business? So it's going to be really interesting to see how comfortable the U.S. population or the international population is getting comfortable back again in person with people once we're allowed to do it, and how many people just aren't, and what affects businesses, what business effects come from that when people just maybe aren't as comfortable being out in public, being shoulder to shoulder.
Yeah, I mean, there's a lot of immune compromised individuals. This is a game changer for them. You know, like, you know, this is a big game changer. You know, like they may not want to leave the house at all. You know, until this whole thing settles down, or if any of this ever happens again, you know. So there's definitely a major psychological impact that has to be accounted for. You know, everyone's like, oh, we're going to snap right back and everything's going to be like it was. And I don't know. I try to be a realist. I don't think that's the case. I think there's going to be change. I don't know what exactly it's going to be, but I believe that this has changed the landscape of a lot of things. You know, life as we know, it's the end of the world as we know it, right? You know that song. So doesn't mean it's the end of the world.
Yeah, I'll play the devil's advocate on that one. We were talking about this yesterday, and I do think, honestly, that there's going to be some massive changes that come out of this. But I also think that as humans, we forget really quickly, and that's a bad thing in a lot of cases as well. You and I were talking yesterday. We had Sandy hit here, right? And we have all the coastal properties in New Jersey. And everybody said, oh, that market's going to get crushed. No one's going to want to buy waterfront property. Nobody's going to want to buy properties in a flood zone anymore. I'm being nice when I say that took 2 years and it exploded again, and everybody wanted to rebuild waterfront properties because there's only so much of it around, and people just kind of forgot and said, you know what, I'm willing to take that risk on. So I hope that doesn't happen with the other side of this, and that people don't forget. But what that looks like, nobody really has an answer.
Yeah, I agree. Yeah, I mean, we do have a tendency to forget. And again, my challenge to that was, you know, Sandy, you know, while affecting coastal communities only, right, mainly anyway, or anywhere near water that experienced the flooding and things of that nature, you know, this is more health related, right? So we kind of, you know, other than the people who stayed in their homes during that storm, right, and maybe had their health jeopardized,
yeah.
You know, this is, our health, and I think we're a little more protective of that. And, I mean, there's, I don't know how many hypochondriacs are out there, but, anyone who's like, OCD and very germ phobia, this is a definite game changer. This is like the worst case scenario. Like, oh my God, a pandemic, I knew it was going to happen. Self-fulfilling prophecy, right?
Anything else that you want to make sure we get across? Any sort of soundbite that if you could give advice to anybody out there to take away from this call, what they should be doing that we haven't hit on?
I think it's a great time for, just in general, again, my background, DJ, but I more consider myself a mortgage professional, just like we have doctors and lawyers and CPAs and financial advisors. We help people with debt management. And I think it's an eye-opener and a great time for people to really look at their finances and see how they can handle these things. Because think about how, this is going to test and expose how strong or not strong our economy is or isn't as a result of this. Can we take a punch, and can people take a punch and get back up? And, it's a great time for people to become more financially aware, more financially savvy, prepare for these things or plan for these things in the future. And, but more importantly, look at the money that's going to be getting sent out and come to them through the stimulus package, and be able to try and do their part to help save the economy. That's the main message. I've already beat that dead horse 100 times on this call, but like, everyone who can make their rent and mortgage payments, if they do that, they're literally saving our economy. That's the message I think that's more important than anything. And become more financially aware and budget better and be ready to take these things. Life does have its uncertainties, and this is a reminder of that, right? And a reminder of how good we really have it, our freedoms and, all the things that are getting taken away from us right now to deal with this, really that appreciation. So I hope that comes back more than anything as a result of this, what we get from this rather than getting through it. What did we get from it? What did we learn? And what opportunities exist in it, so this is going to create new opportunities. We're very, the great thing about us as people, we're super creative. We always find ways, right? So, like the necessity, the mother of invention, I'm really, my interest is peaked to see what kind of new things come out of this as a result of it. I was joking around with my son the other day. I'm like, like the fist pound, like the fist bump, now we do that, but we don't even touch fist. Like, that's a thing now. Like, that didn't exist before, and now it does. So, like, all the little things are mannerisms and our ways of being with each other. So it's interesting times with all that. So,
well, I appreciate it. I think you dropped a lot of knowledge on everybody here. If you guys jumped on the call late, this will be reposted again. So please make sure you go back and listen. Steve hits a lot of points about if you can afford to continue paying your mortgage or your rent, please do that. Prioritize your mortgage or at least your home where you're residing. Prioritize that over the top of car payments and credit card payments and all of that. But thanks. I appreciate you being on, Steve. I know everybody else here does as well. If we missed any questions, guys, please feel free to chat those in and we'll get them answered after the fact. But thank you guys for hopping on with us today, 1 o'clock on a Saturday. And Steve, thank you for making time for us. I appreciate it.
Yeah, guys, be well.
All right, guys. Talk to you soon.
All right, see ya.